hablando de inversiones con criterios ESG. Para tratar este asunto nos acompaña en los próximos minutos Mead, Investment Strategist, Equities in Alliance Bernstein. Hello.
Hi, good afternoon.
Kate, what is ESG materiality and why does it matter?
Yes, thank you. Going straight into the topic of ESG. So most of us will be familiar with the acronym ESG, which just for clarity stands for environmental, social and governance. And some ESG factors will have a direct impact on a company's financial performance and can either help contribute to or detract from security returns. And some of these may be less impactful ESG factors, but where those factors are directly impacting a business and their financial performance, it makes sense for active investors to include these factors in our security analysis and investment selection where it's appropriate. But it doesn't always make sense to take a uniform approach. There can be quite wide disparity in that materiality level. So understanding this dynamic can be key in successfully incorporating ESG risks and opportunity into our analysis. And so materiality for us, when it comes to ESG, refers to how significant an environmental, social, or governance factor can be, and how much impact that can have on the financial performance of a company. But not all ESG issues are equally important for every market, for every industry, or for every stock. For example, carbon emissions can be critical for energy companies, while data privacy is often more material for technology or healthcare firms. So therefore, when we're thinking about materiality, we should focus on what's financially relevant rather than thinking about one size fits all. So we focus on ESG issues that are likely to affect cash flows, risk profile, and ultimately valuations. And we believe it's a way to sharpen our research lens and ensure that we're investing responsibly and intelligently, considering all material factors, whether that's ESG or not ESG.
Kate, how can we identify which ESG factors are material?
So there's definitely a number of ways that we can slice and dice all of the ESG data that we have. This can be at a country level, sector, or even stock level. And recently here at Alliance Bernstein, we've undertaken some research on the materiality of various ESG factors. And one method we used as part of this research was some factor attribution analysis using historical returns. So we looked at historical data to see which ESG metrics have consistently influenced stock performance over time. So we were able to take a look at factors like workplace incidents or social fines, as they're known in the bond world, and look at the level of ESG disclosures, for example, CFO tenure, whether or not a company separates the CEO and chair of the board roles. We were able to rank those factors and look at the impact of share price performance on those companies. And so by using that backtesting methodology, we were able to identify some ESG metrics that are financially predictive. And so that's helped us move from theory to evidence and help us to distinguish between factors that are have the potential to be truly predictive when it comes to that financial performance.
Kate, are these ESG factors that matter across all sectors?
So as a starting point, we can think about actually factors that are specific to sectors or industries, as well as those that are relevant more across the board. So as I mentioned earlier, in theory, you'd think high-level greenhouse gas emissions might be more relevant for a mining or electric utility business, and thinking about data privacy or customer privacy, more of a concern for healthcare. But from this starting point, we can take a deeper dive into a specific factor and see whether it's more relevant for the whole market or just a specific sector. And so using that methodology that I outlined previously, we have actually found that some factors can be financially material, for all companies in a market, regardless of the sector that they're in. So, for example, we looked at the MSCI All Country World Index, or the MSCI ACWI, and we ranked them according to the number of workplace injuries that a business had. And what we saw in those results, companies with a higher level of workplace injury consistently underperformed the market. But on the flip side, those with lower rates of injury actually outperformed. And we saw that regardless of sector. So we can say this is a factor that has the potential to be financially material for all companies, regardless of sector. Some other factors that we identified that were applicable across all sectors included the tenure of the CEO, for example, or employee turnover. But as you might expect, there are some factors which are more specific to certain sectors and might be less relevant for other sectors. So, for example, we also looked at water usage intensity. So when we were looking at the consumer staples sector, businesses in that sector that had the lowest water usage outperformed the index compared to businesses with higher water usage. And that was in the consumer staples sector. On the flip side, we also looked at high water usage in financials sector. But here we didn't see a consistent pattern. So it was no consistent pattern for performance versus water usage in the financial sector. So what we can deem from that pattern is that for the financials businesses, that ESG factor of water usage is not materially important. So it's definitely worth keeping an eye on those factors that are important across sectors or are more universal, like injuries. But we shouldn't forget that some factors might be more financially material depending which sector you're looking at.
And my last question, Kate, what's the practical takeaway for investors?
So the practical takeaway for investors that we can think about today is that really focusing on the most material ESG factors can provide a really great starting point for identifying risk and also opportunity in your analysis. We've looked, and I've highlighted today, some of that high-level research. So we've looked at big data sets, but we know that within ESG, we don't always have that adequate set of data or the granularity. So it's really important for investors to look at those pieces of research, but complement that with fundamental research. So if we think about carbon emissions, for example, we can go beyond high-level carbon emissions data, and we can think about that data point in a way that gives more insight and context into a particular business. So if we think about an automaker, we can measure carbon emissions in terms of miles per gallon, or for a building company, we can think about emissions per ton of cement produced. And this can help us really fully understand the nuance of that ESG factor and to really identify and understand how material that factor is to a business. So the key for investors is to focus on material factors, and that can be through that research we've outlined above, as well as fundamental research. So we should prioritize material factors, customize analysis based on the sector or company specifics that we're looking at, as well as using ESG data where we've got it and it's available. And overall, that means that we and investors alike can better assess risk and opportunity, and identifying those factors that really count, we can better manage risk as well as uncover opportunity and deliver value for clients.
Kate Mead, investment strategist, equities in Alliance Bernstein. Thank you for joining us.
Thank you.
Good afternoon.